that they were picking up the language from Jay Powell at the Federal Reserve saying it's transitory, and then they remember, Mike, I have to always go back to the giant Build Back Better plan, where they actually had the audacity to look at the American people and say, we need to spend money to fight inflation.
You know, I think Biden brought up that gem a week or two ago. But it's just a total disconnect, and I'd say complete discontent for the everyday average American, right? One of the White House advisors was saying over this weekend that he's not feeling any sort of inflation. They simply don't care. They see that it's a political issue, and now they're paying some lip service. But to touch on what Liz said, Mayor Pete has done absolutely nothing. They're blaming the supply chain. He's the Secretary of Transportation. It is part of his job to work on this. And you combine that with the day that he got in office, stopping the Keystone XL pipeline, just a total and complete war on fossil fuels, in addition to insane regulation. So it's, look, well, part of the reason we have such a huge Fed balance sheet is the last time Democrats were in the White House, their regulation brought forth one of the most anemic, if not the most anemic recovery in history. Right. Commerce Secretary Riamaldo said that over the weekend. So, look, Biden doesn't have the Fed to bail him out now. In fact, the Fed is going to be working actively against him because we've gone way too far. So, look, this is going to be a bloodbath in November. It's just a matter of how big and how much.
Before we go, really quickly, Liz, time for the word on Wall Street. Top investors watching your money this morning. Joining me right now, Laffer Tangler Investments, Arthur Laffer Jr., Michael Lee Strategy founder, Michael Lee, and Bulltick Capital Markets chief strategist, Catherine Rooney Vera. Welcome, one and all. Mike, let me start with you. Futures are up this morning after Friday's technology-led sell-off. It was a losing week for the markets last week. Much on investors' radar. What are you watching? What are your thoughts on the swings, the volatility here?
So, Dagan, I think what we're seeing is a classic bear market rally. When we get in these situations, the market waits for everybody to get short and sentiment to get extremely bearish, and then they go out and they just destroy the short sellers. I'm using these opportunities to sell my high volatility fixed income, as well as technology and the equity sectors that I own that have higher multiples that I maybe should have lightened up more on earlier this year. I think if you look at the long-term average of the price-to-earnings multiple on the S&P 500, it's around a 16, and you're either way above it or you're way below it. And I think we were headed for one of those periods where you are way below that 16 multiple, perhaps going to a 12 or 13 multiple for some years until the market can completely reorganize itself. And so what I'm out there buying and owning is my largest position is energy. Then I have a bunch in staples and utilities, and that's where I'm sitting now until the market expects a Fed pivot. And once we see that Fed pivot, I don't know that we're necessarily off to the races, but I think the market starts to recover, and you could start to own the consumer cyclicals, technology, and those sorts of assets. But in these time frames, you see these vicious bear market rallies, which what I think we're seeing right now. You still have extraordinarily bearish sentiment. You don't have a lot of longs in the market, and you have a lot of shorts. So when that happens, the market tends to reverse itself very, very quickly. Look, I'll take anything that makes the market go higher, but I am not optimistic that we're going to be hitting new highs anytime soon.
All right, oil prices are up this morning, both Brent and West Texas Intermediate. And Michael, look, and I was in a luxury goods store talking to one of the sales representatives yesterday and just having a conversation, and that store had gotten hit by robbers not that long ago. And he was just talking about how terrifying it is. And this chain that he works for can eat those losses, but there is not. These individuals are not being arrested and put in jail and prosecuted and kept in jail. So if our jails, particularly here in New York City and all these other large left-wing cities, if it's just a revolving door, crime begets crime begets crime. And you have one criminal who's arrested for shoplifting or theft back out on the street. And how do you think it winds up turning into violent crime, Mike?
Dagan, they found when Giuliani took over that the people committing the small crimes, the people squeegeeing your windows with newspaper, jumping turnstiles, shoplifting, those were the same people committing violent crimes. And now not only do you not have no bail, you have no qualified immunity. Police officers are very limited in what they can do in terms of restraining these criminals. You have a total and complete demoralization of the people trying to keep everyone safe. Okay, and just a part of a larger, broader total war on anybody that tries to enforce existing law so that new laws can be ushered in and the government can come up with greater control of our everyday lives. I'm in disagreement with Liz only on the thesis that we need more gun laws. We don't remotely enforce the gun laws that are on the books. Most of these shooting crimes that are happening in these major cities have the strictest gun laws in the country, and it always happens there. And it's almost you have to ask yourself, at what point is this intentional? So that they come in and sweep, and take complete control of everyone's life in these inner cities.
Well, maybe there's a turning point that's going to happen tomorrow, Liz. Really quickly.
Hi, Paul. My thought is that we are now the market is changing. The world is changing. We're going from the most accommodative Fed to the first time a Fed's really going to have to tighten in, I don't know, since maybe 2006, because I personally think this tightening cycle is going to be longer than the one of 16, 17, 18. So my thought is that price to earnings multiples are coming in, and we're going from a 18, 19, 20 in the S&P 500 to a 12, 13, 14. Do you see any scenario that reverses this sort of my thesis of multiple contraction? And if you don't, what are you guys doing to prepare for this? Because I certainly don't think in a shrinking economy where earnings are too high and liquidity is tightening that we could see any case for multiple expansion. But I'm anxious to hear your thoughts.
Yeah, that's a great question, Mike. Thanks very much for asking that. We do see multiple contraction. There's already been some, and we think multiple contraction will be the biggest driver of stock prices this year. But let's not forget that earnings, with the economy still having some kind of buffer, right? There's still some savings. There's still a lot of cash. There's still job gains, and there's still nominal wage growth. Those are all buffers that will gradually be eroded. But as they're still holding up, you will get some positive earnings growth. So we're looking for a contraction or compression in multiples, but still some positive earnings growth in 2022.
Liz Peek, get in here.